Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the yield curve and how it can be used to better understand and predict recessions. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Also, make sure you sign up for the ITC newsletter. You can find a link to that in the description below. We just picked out someone to have a free month of ITC Premium for September, going for 1 month, and we'll pick out someone again next month. So make sure you sign up if you want a chance to win that. In this video, I'm going to try to slowly and meticulously go through a few things that I think are important for investors to understand and tools that I think are available to them to better navigate financial markets. I want to preface this by saying a lot of people think that we're already in a recession. And to be completely honest, I am one of them, right? I am one of them. I also know a lot of people that I do not think are politically motivated, that are analysts that back up their arguments with data and would argue that while the market conditions look fairly bleak, there are some indicators that do not yet suggest we are in a recession. However, we are getting relatively close. Okay, so before we try to jump to any conclusions as to, or get too upset if someone, say, holds a different opinion than you, why don't we try to understand why they think the way they do, and then we can try to form our own conclusions. I think this makes a lot more sense than just saying, oh no, you're wrong, you don't know what you're talking about. Okay, so we're going to slowly go through this. I'm going to try to explain it the best I can. I'm not an expert at it, but I'll try to put on my macroeconomics hat for a few minutes to just kind of go through a few things. So the yield curve is a great tool that I think all investors should be aware of. And before we get too far into it, one of the things you'll notice is that on this yield curve, we have the 1 month, the 2 month, the 3 month, the 6 month, the 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, and 30 year. Okay, so you basically have the option to seek out yield over various time frames to earn various percentages or various yields, right? A certain percentage over or annually, right? So for instance, if you wanted to seek out the 1 year, you could basically get 4% APY. All right. Now, as likely many of you are crypto investors, because this channel is mostly built around cryptocurrency, a lot of people are going to look at that and be like, what's been smoking talking about 4% yield? If you look at 2020 and 2021, right, a portfolio going up 4% is just like a Tuesday afternoon. This is not something you wait a year for. If you look at 2022 though, and you look at your portfolio and you're honest with yourself and you say, well, a lot of these cryptocurrencies and a lot of these stocks are down a lot, and they could stay down a lot for a while, for all we know. It makes sense to start at least considering what are your options if you haven't already done so. One of the things I've said this year is that cash is king, and I've talked about this for basically the entire year, that cash is king, and that really you need to be, it makes sense to have cash in hand for next year and later on this year and especially next year. One of the things I've mentioned with that is the difference between being risk on and risk off. Now, over the last several years, yields have been really historically low. And a lot of people aren't going to go, put their money in something that's going to yield them 0.25% annually, right? It's just not enough to care about. And so they seek out yield somewhere else, meaning they go risk on. They invest in, say, stocks, in crypto, maybe in something else, but they invested in something and they're going risk on to try to find yield somewhere, to at least try to keep up with inflation or maybe outperform inflation. However, as yields continue to go up on these things that are, considered, right, quote unquote, risk-free, it makes more and more investors go from being risk on to being risk off. The reason is because if the macroeconomic outlook is relatively bleak and you don't want to put your money into risk assets right now because you think either it could go lower or maybe you don't care if it's going lower or not, you just don't want to deal with the volatility, you might be interested in things like fixed income investments where you put money in something and after a certain period of time, you're going to get some money back. And you don't have to worry about all the volatility that comes with it, right? Now, I'm not a financial advisor. This is not financial advice. Generally speaking, diversification is a good thing. So while it might seem like, maybe getting some of these, sort of like risk-free yield might sound relatively unattractive because you think like it's just not a lot, there are things where you could do a little bit in something and then a little bit in something else. That way you're hedged either way. For instance, if you wanted to seek out yield, there are various time frames on the treasuries, right? I mean, there's 1 month, there's 2, there's 3, there's 6. I mean, you could find several different things. And what a lot of people do is they sort of ladder it, right? So you might have one that unlocks in 3 months, one that unlocks in 6 months, one that unlocks in 9 months, and then one that unlocks in a year. Okay? And when those come to maturity, you can figure out, all right, let me take a look at the economy. Oh, no, it still looks bad. Okay, I'll lock it up for another 3 months or something. And then you have another one that unlocks, maybe a month after that or a few months after that. Oh, does the economy look better? Oh, no, I still want to put it in another one. Eventually you might get to the point where, hey, the economy is starting to look better. Now, I want to go back to being risk on. And you start to seek out yield somewhere else because you think the stock market could outperform, say, some of these more risk-free investment vehicles. Okay? Now, where does this come back to recessions? One of the reasons, one of the ways that we predict or we call for recessions is the 2 consecutive quarters of negative GDP. And I think this is probably a technical indicator that most people use, and I think it's a really worthwhile tool to use. And personally, I think we're in a recession. It feels like we're in a recession, but I also respect the opinions of people who say we're not in a recession, and I try to understand why is that. There's I think there's 2 important spreads that we could look at. We're going to look at just these 2 in this video. We're going to look at the 3-month and the 10-year. And we're also going to look at the 2-year and the 10-year, okay? Now, some people might say that when the yield curve inverts, it's predicting a recession, okay? When it inverts. But there's various time frames that could invert. You could have the 2-year inverted with a 10-year, but maybe you don't have the 3-month inverted with a 10-year. For instance, right now, what I mean by inverted is you can actually earn a higher interest rate on a 2-year than a 10-year. This is inverted, okay? It's inverted from what it would be under most circumstances. You would expect if you're going in for a longer, a longer time frame that you should be able to get access to a better yield. That's not always the case. And when this happens, it is often a sign of a looming recession, a recession that will occur at some point in the not so distant future. If I bring this up, we'll first look at the 10-year and the 2-year. You can see that when it goes below 0, it's getting inverted. The 2-year is inverted with the 10-year, meaning the 2-year, you're now getting a higher yield than you would with a 10-year. You can see that going back really to the 1970s, it's happened a number of times. The most recent one, in fact, was back over here. If we zoom in 2019. And you might say, well, did that predict a recession? Well, technically, yes. During the pandemic in 2020, we had a very brief recession. And arguably, that recession would have been a lot worse had the Federal Reserve not printed their way out of it. Okay? And it led to a booming bull market that lasted like a couple of years or so, maybe a little bit less. And they kicked the can down the road. They said, we're not going to deal with these problems right now. We'll deal with it later. And that's what we're paying the price for right now. Okay? So yes, the inversion worked, right? The 2-year went below the 10-year. A few months later, we had a recession. Let's go back even further. You go back to, say, 2006, we had this invert twice, and maybe more, maybe 3 times, right? This inverted multiple times over here. And then we had a recession over here starting at the end of 2007, right? And go back even further. You can see it inverted over here. And it came down pretty far in the year 2000. Right after it, in 2001, we had a recession. You can continue to go back and see that the inversion of the yield curve with the 2-year and the 10-year is pretty good at predicting recessions. Okay? So this is why a lot of people, in addition to pointing to 2 quarters of consecutive contraction with the GDP of the United States, would say that we are in fact in a recession. However, there are also plenty of people that would say a better indicator is when the 3-month inverts the 10-year, not the 2-year. Not the 2-year inverting with the 10-year, but the 3-month inverting with the 10-year. And you can see right now that the yield on the 3-month is only 3.169% compared to the 10-year, which is 3.451%. The spread on this, and I have it on here, the spread on the 10-year to 2-year is negative 42 basis points, meaning it's inverted already. But the spread on the 10-year and the 3-year is 28 basis points, meaning it has not yet inverted. If you go look at the inversion of the 10-year and the 3-month, it looks a little bit cleaner, right? The 10-year and the 2-year looks like this. It's not quite as clean, right? There's a lot more maybe false signals and whatnot. The 10-year and the 3-month looks a little bit more clean. Not perfect, right? But it looks a little cleaner. You had an inversion here where it came down. The spread ended up being what? Negative 0.6, okay? Negative 60 basis points. You go over here in 2019, we had it negative 0.49 or so. Over here in 2000, negative 0.77, so negative 77 basis points. These both led to recessions. In 1990, same thing. Okay, so a lot of economists would actually prefer the 3-month and the 10-year. And you can see they have not actually crossed yet, but they are getting dangerously close. Okay? So there are some economists that say, yeah, technically speaking, we have had 2 quarters of negative growth. Technically speaking, the 2-year has inverted with the 10-year. But also, technically speaking, the 3-month has not inverted with the 10-year. And also, unemployment is still relatively low. I mean, I get the data is somewhat convoluted on unemployment, but this is an indicator you could point to, right? You could say unemployment's relatively low. Therefore, why do we have any business calling it a recession? This is the argument. If you go look at interest rates, you can see that the Fed funds rate is now at 2.5%. Now, a lot of investors are up in arms over this, right? 2.5% seems insane. I think the Federal Reserve has made it fairly clear they're going much higher. I think a lot of investors don't want to believe them, but they've made it fairly clear. And why? Because inflation is still out of control. Not only is headline CPI not coming down as quickly as people would like it to, coming down from 8.5 to 8.3% over the last month, year over year, but core CPI actually went up from 5.9% year over year a month ago to 6.3% this month. I mean, it's looking back 1 month, but that's an increase. And core CPI excludes the food sector and energy sector. So if you think about it like that, you could say, well, inflation's not really going the direction the Fed wants, especially core CPI, which is arguably what they care about more. And headline CPI, while it is going in the right direction, generally speaking, over the short term, what if it starts going the other way next month? Or what happens if it just gets somewhat comfortable at around 8% for a while? This is not a good thing either. So the Fed is going to continue raising interest rates. Now, if you think back several months ago, a lot of people were saying the Fed's done raising rates, or if they do raise rates, it's only going to be 25 basis points. Now, markets are saying that next week, there's a 77% chance the Fed will raise interest rates by 75 basis points. A few days ago, there was a 9% chance they were only going to raise by 50 basis points. But that possibility, according to markets, is 0% now. The markets right now are saying there's no chance that the Fed will raise 50 basis points this month. Now, that could change, but there's not a lot of time between now and the next Fed meeting, so the markets seem fairly convinced. What's more interesting is that a week ago, markets said there was a 0% chance that the Fed would raise by 100 basis points. Now there's a 23% chance that the Fed will raise by 100 basis points. Now, clearly, the most likely outcome is a 75 basis point rate hike, right? That's what markets are saying. This is what I've thought all along, right? I mean, I continue to think they're going to remain aggressive and there's no pivot coming. Not right now. 77% chance, 75 basis point rate hike. What's more interesting is that this recent inflation data not only affected the likelihood of a 75 basis rate point hike at the next meeting, but in November, markets also think there's going to be a 75 basis point rate hike, assuming we have a 75 basis point at that one. Okay, if the one that we have next week, if it ends up being 100%, then we would only need if it only ends up being 100 basis points, then by the next one, this would just be a 50 basis point rate hike, because I mean 100 would get us to 325 to 350. Therefore, from a 50 from there would get us up to 375 to 400. So I'm saying if we get 75 basis point here, and this is also getting us to 375 to 400, that's another 75 basis point rate hike. That's currently being shown as the most likely scenario according to markets at the November meeting, which means that over the next two meetings, the Fed could raise 150 basis points if the market is right. That gets us to 4%. Okay? I mean, I know a lot of people think that and I've seen this I've seen this at across the board. A lot of people think this, and markets say otherwise right now. But a lot of people think that 3.5 is as high as they can go. Markets say no, they can go higher. And in fact, if you continue going at the December meeting, markets say they're going to keep going up. There's a between these two, there's basically like an 80% chance that by the end of the year, the Fed funds rate is going to be somewhere between 4 to 4.5%. I believe the market. I mean, the market can change their opinion, of course. Therefore, right, strong opinions loosely held. But that's what the market currently says. Now, how does that affect you? Well, if the Fed keeps raising rates, then these yields are going to keep going up. Investors are going to consider their options continuously. Do I want to put it in the stock market? Do I want to put it in some fixed income asset that I can get 4% or 5% or maybe even more risk-free? Okay? This is the difference between risk off and risk on. Again, it doesn't have to be all or nothing. You could have some risk assets and you could have some that are, that you're more risk off with. One thing I've thought about too is a lot of people this day and age, speaking like I've experienced it, I haven't, but a lot of people say like, oh, 2.5% is high. 3.5% is ridiculous. Back in the 80s, it was like 9%, even going up to 20% at one point. Now, the counter argument to this as well, the debt to GDP is a lot different now than it was back then. Therefore, there's no way they can go past 3.5%. The counter argument to that as well, the debt is denominated in US dollars, which they can freely print. So what's the big deal? It's not like it's impossible for them to necessarily overcome this. I don't agree with it. I do think they can go above 3.5%. I don't think 3.5% is a hard cap on the Fed funds rate. That doesn't mean they have to go above 3.5%. I mean, anything can happen. But I think it's much more likely that the Fed will eventually get above 3.5%. I think, going to 4 to 5% makes the most amount of sense. And as I've said before, a lot of people want the Fed to pivot. Okay? They do. I don't. I really don't. And I will explain why again. If they pivot prematurely, inflation, okay, the green shaded areas are recessions, by the way. If they pivot prematurely, inflation will likely just come right back. Okay? We might be able to enjoy a brief rally in the stock market for a little bit. Okay? Maybe more than just a month or something. Maybe like a year. I don't know, 6 months, 12 months. Maybe we get to a new all-time high, and then we just come right back down. I don't want to live in that world. Okay? I want to live in a world where inflation comes back down. Why? Why do I want to live in that world as opposed to the Fed pivoting earlier? The reason I want to live in that world is because if you look at the stock market, if you look at, say, like the S&P 500, which is what we're going to do, after inflation comes back down, that's when you go into a really nice bull market after it comes back down, right? After it gets back down to say, where more so the target is, that's when you start to see more impressive rallies in the S&P 500. What happens when inflation stays high, like it did over here in the 70s? Stock market goes sideways, like it did in the 40s when inflation was high. The stock market, right, it gets relatively boring. And it starts to go up after inflation finally starts to come back down, and it leads into a more booming economy where the stock market just goes up much more frequently. So while a lot of people would like the Fed to pivot sooner rather than later, I would urge you to reconsider that stance, because if they pivot too early, the likely outcome is that inflation is just going to come rear its ugly head again, and then they're going to have to go back to quantitative tightening for a while, and therefore you could see some type of a market where the S&P continues to put in higher highs and lower lows. It's not a world I want to live in, right? I'm not a trader much, to be completely honest. I mean, I do take advantage of crypto market cycles. I mean, in the most recent market cycle for crypto, I took most of my profits, admittedly, in early 2021. Not nearly as much in later 2021 and early 2022, but I did some, especially when it became apparent to me that the bull market was over. I did, and ever since Q1 of this year, I've been just sort of saying cash is king. But I don't want to live in a world where the stock market just goes sideways for 10 years. I want the Fed to get inflation under control. If you think back, it was Volcker in the 80s, again, who led us into 2 recessions, but it got inflation down. And then after inflation got down, the stock market boomed for what? 20 years. Okay? So, would you rather have a short-term bull market for the stock market? Or would you rather just deal with the pain now, get it over with, and then go up? So I'm rooting for the more hawkish stance. I know that makes me a bear, right? So be it, right? My name is Ben and I'm a bear. I think it makes more sense for the stock market, or say for the Fed, to remain hawkish until inflation is coming back down. And once inflation is back down, then we can start talking about, all right, let's pivot, right? Let's pivot, and we'll hopefully see a booming economy once again. Going back to the 3-month and the 10-year, they have not yet inverted, okay? They have not yet inverted. If they were to invert, a lot more people would say we're in a recession, right? Because it'd be like, well, this is the indicator they're looking at. They would say we're in a recession. If you go look at the S&P during the last few recessions, one of the things you'll notice, not always, but I'm not showing all of them on here, but one of the things you'll notice is that the market usually bottoms part of the way through the recession. Not always, okay? If you look back at 2008, 2007, 2008, 2009, the stock market bottomed before the recession was over. Okay, if you had waited for the recession to be declared over before you started buying stocks, and by that point the stock market was already up 40%. So I don't think it's necessarily wise to always say, well, the market won't turn around until the recession's over. So you consider that. You go back over here to the 90s, you can also see that by the time the recession was declared over, the market was already up 25% or so. If you go to the dot-com crash, which there are some similarities. I mean, I've painted a lot of the similarities between the dot-com crash and the crypto crash. So I'm not trying to shy away from anything. You can see that the bottom ended up coming later in 2002. So there's not like a one size fits all type solution here. I wish there were. I wish they were that easy. But the truth is that oftentimes once a recession has been identified, the bottom, at least out of the last 3, I'm not even showing the one over here in 2020, but let's just ignore that one for now because it was so brief. The bottom occurred either in the recession or after it, out of these 3 case studies, okay? Out of these 3. Right now, there hasn't even been an officially declared recession. by the time it's officially declared, there's a good chance we'll actually be near the end of it. So think about that. Remember, the stock market is forward looking. So it will likely bottom well before the recession is over. Now, there does exist a chance where that's not the case. But a lot of times, like if you look over here, but a lot of times it does tend to be the case that the stock market will bottom before the recession is actually over. And right now, they haven't even declared a recession. If you see the 10-year invert with a 3-month, you'll likely see a few more people saying, okay, it's a recession. If you see another quarter of negative growth, GDP, more people will start to say, it's a recession. Maybe it takes 2 more quarters or something for the Fed, or not for the Fed, but for the powers that be finally declare, okay, we're in a recession. But by that point, we might already be like 2/3 of the way through the recession, and that could actually mark the bottom for the S&P. So just consider this. And remember, as long as the Fed raises interest rates, which is what they're going to continue to do, more than likely, of course, and we're showing that here. The odds are pretty high. 82% chance 75 basis point rate hike next week. 18% chance 100 basis point rate hike next week. Okay, as long as they keep raising interest rates, you're going to continue to see the yields go up. As long as the yields go up, more and more investors are going to seriously consider, why not just take on this investment where you can get something risk-free as opposed to risking it in risk assets like the stock market and cryptocurrencies, when it looks like, historically, it looks like the S&P doesn't even bottom until either part of the way through the recession or after it. And we're not even technically, according to the powers that be again, we're not even technically in a recession yet. And it might take the yield curve, say, inverting on 3-month and the 10-year. It might take another quarter of negative GDP. Maybe it takes unemployment going up. Who the hell knows what it's going to take? But if that's the case, then it could still be a while. You might wonder, why is that important? Well, once a recession is declared, they're probably going to have to do something. They're going to try to do something about it. That's the point, right? That's the case in point, is that if they're finally admitting it's a recession, then there's going to be a lot more pressure on the Federal Reserve to actually pivot. Right now, the Federal Reserve can just go point to things like unemployment, right? They can just say, well, technically unemployment is at historical lows. Why do we need to pivot? Okay? But over the coming months, unemployment is likely going to go up, and hopefully inflation comes down. So the game plan, what I would like to see is I would like to see Powell stay with his conviction that inflation needs to come under control, to continue to raise interest rates, which will help slow down inflation, right? And I would like to see that happen before unemployment goes sky high. The reason is because after unemployment goes up, after there's more indicators that we're in a recession, there'll be mounting pressure on the Federal Reserve to pivot. And if they pivot before inflation is back down to their target rate of, say, 2% or so, then we're likely going to go into a more inflationary period where you could see several years of just sideways market action, where maybe we put a new all-time high, then we go to a new low, and then a new all-time high, and then a new low. This is not really a market I want to be in. I'm not really that interested in say swing trading in the equity market. I'm more just a long-term investor, but this is just something to consider. So you can kind of see things are starting to move now. Unemployment is slowly starting to go up. Okay, the 10-year is on its way to being inverted with the 3-month. Interest rates are going up. More and more investors are going from risk on to risk off. Okay, kind of see how it all works together. So I hope this video has been useful in trying to sort of bring everything together and help people understand, how are all these things connected? What happened? How does it affect you if the Federal Reserve's raising interest rates? Well, listen, if they're raising interest rates, you have investment vehicles that are offering yields that you didn't have access to before. So I think you should know that, right? I think that's something important you should know. Whether you take advantage of it is obviously up to you, but it is at least something that you should know. And if we are heading towards a recession, then we're going to want to keep a close eye on that and its relation to the S&P 500 and looking for, a bottom on that as we continue to navigate these financial markets. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. We have Into the Cryptoverse Premium at intothecryptoverse.com. I know it's called Into the Cryptoverse Premium, but we also have a lot of stuff for stocks and precious metals and Forex, some other stuff as well. So if you're interested in that, you can also, there's also plenty of charts for that sort of stuff as well, not just crypto. I started everything with crypto. That's where things are the most volatile. And that's where most people, at least that follow me, are interested. But we have built out some tools other than that. And also we do have the free newsletter, which I would encourage you to check out, again, in the description below and in the pinned comment. Thank you guys for tuning in. Subscribe if you're not subscribed. Give the video a thumbs up. See you guys next time. Bye.